In a single week, China flipped the script on global trade without saying a word. Rare earth exports to the US gone. Ports like Los Angeles, already down 30% year over year, hit their lowest cargo levels since the 2020 lockdown. Treasury Secretary Scott Bessant's out there, publicly claiming America's stronger than ever, while privately begging for a call with Xi Jinping. Meanwhile, the dollar's dipped below 99.2 for the first time in 2025. Bond yields are spiking, and foreign investors are yanking billions from US debt.
This isn't a negotiation. It's a calculated squeeze. China's not issuing demands or holding press conferences. They're just quietly weaponizing supply chains. According to Reuters, Beijing's restricted rare earth exports, again, choking 70% of America's critical mineral imports.
The US military needs rare earth minerals to function, but China's recently imposed restrictions on their export is raising national security concerns. No public ban, just unrenewed licenses and a 19% drop in shipments month over month. Suppliers in Jiangxi, they've paused exports to unfriendly markets, per the Financial Times. China controls 87% of global refined rare earths, and nearly 100% of heavy rare earths. Think EVs, defense systems, Tesla, Raytheon. One customs code tweak and the US is scrambling. On May 31, 2025, the US extended Section 301 tariff exclusions on Chinese imports, smartphones, medical gear, semiconductors until August 31st. But what's not being shouted from the rooftops is what's unraveling beneath. While Bessant accuses China of withholding supplies on Face the Nation, he's also pushing for high-level talks with no policy rollback on the table. You can't threaten your supplier and ask for a discount at the same time. And with Trump doubling down on reshoring semiconductor fabs, what happens when Beijing still controls the raw materials? Washington's not slowing down either. The Bureau of Industry and Security just tightened export controls on AI-enabling chip design software like Synopsys and Cadence for Chinese use. The Wall Street Journal reports new secondary sanctions are coming for allies buying Huawei's 7-nanometer chips. Senator Rubio's even pushing to revoke visas for 300,000 Chinese students. Bessant calls it de-risking, not decoupling. China's not buying it. Their Ministry of Commerce told state media they'll hit back hard against what they call violations of the May Truce. At the port of Long Beach, CEO Mario Corderero told CNBC that no Chinese ships arrived last week, the worst traffic since early Kouchon. What we're looking at is less vessel calls to the port of Long Beach, which means less cargo volume, which means less products that could eventually not be on the shelves. Importers aren't betting on stable policy anymore, not with Trump's 145% retaliatory tariffs live since May. This trade war's price tag is real, and it's hitting now. So who's really calling the shots? China's export office or America's shrinking leverage? This isn't diplomacy, it's a slow-motion financial demolition, and it's already started. Coffee prices have surged 17% in just 3 weeks, according to ICE futures data, with Colombian beans making up 30% of US imports now hit by new duties. Meanwhile, the US dollar index has slid 10.2% from its 2024 peak of 110 to below 99.2, slashing real returns for foreign investors holding US debt. Bloomberg reports the yen carry trade, a major driver of global dollar demand, is unraveling as Japan's 10-year yields hit 1.5%, the highest since 2012. Economic gravity is catching up. Treasury Secretary Scott Bessant keeps pointing to China's struggles, but ignores the US's own issues. We're now paying 4.8% interest to borrow for 30 years, up 73 basis points in just 60 days. So who's really defying gravity, and how long until the debt bill comes due? On May 30th, the US 5-year Treasury auction saw its weakest foreign demand since 2019, with indirect bids dropping to 56% per Treasury data. Meanwhile, 30-year yields spiked to 4.98%, a clear sign investors are losing faith in the long-term outlook. Bessant, in a CBS interview, insisted the US would never default and claimed the debt ceiling would be raised without a hitch. But he dodged naming a specific deadline, even though the Bipartisan Policy Center projects a cash shortfall by mid-August. Moody's recent downgrade highlighted fiscal irresponsibility and political gridlock as key risks. For bondholders, the real threat isn't missed payments, it's value erosion. A 10% drop in the dollar wipes out yield advantages, especially for foreign investors. The result, rising yields, falling bond prices, and a shrinking pool of buyers. If confidence drives debt markets, Washington's running on fumes. On May 31st, JP Morgan CEO Jamie Dimon warned at the Reagan National Economic Forum that the US bond market is one policy mistake away from cracking. He pointed to unchecked fiscal stimulus and post-COVID quantitative easing as key culprits behind a fragile Treasury system now strained by a $25 trillion deficit expansion. The national debt has already topped $37.1 trillion. Bessant brushed off Dimon's warning, claiming none of his predictions have come true. But Bloomberg data shows foreign holdings of US Treasuries fell to $7.4 trillion in April, down $110 billion in 60 days. That's not opinion, it's capital flight. Bessant insists the deficit will shrink over 4 years, but CBO data tells a different story. The 2025 fiscal year shortfall has already hit $1.02 trillion as of April, up from $860 billion last year. With a major spending bill still awaiting Senate approval, Moody's analysts predict the debt ceiling will jump another $4 trillion by year-end. Dimon's not just speculating, he's diagnosing Bessant's response, not a plan, but a sales pitch. And it's not just debt. Back in January, Bessant and Trump promised 90 trade deals in 90 days. 5 months later, only one deal with the UK exists, and it hasn't even boosted shipping volumes. The Port of Los Angeles reports 0 cargo departures from China on May 10th, a collapse not seen since the bottlenecks of 2020. Retailers in San Pedro Bay are facing shortages in electronics and raw materials, while Shanghai procurement contracts are stalled over tariff fears. Axios confirms Beijing has paused all tech shipments not under long-term contracts, citing policy uncertainty. US trade officials call this a temporary blip, but the numbers say otherwise. Walmart just hiked prices by 3.4% to 4% in May alone, blaming volatile shipping costs from Asia. Meanwhile, the Institute for Supply Management reported a 6-point drop in new US manufacturing orders, the steepest since 2022. This isn't just a trade spat, it's an economic gut punch. If new trade deals don't materialize by Q3, this offshore squeeze will hit your local store shelves hard. Scott Bessant claims China's eating 65% of the tariffs, leaning on a 2019 NBER study, but the numbers tell a different story. US Customs and Border Protection says tariff revenue has hit $177 billion since 2018. Yet the Peterson Institute shows consumer prices for tariff goods up 11.3% on average. In May 2025, Chinese-sourced electronics jumped 4.8%. Retailers like Walmart, Best Buy, and Dollar General are passing those costs to you. Bessant argues Chinese exporters are footing the bill, but reality disagrees. Chinese shipments to the US are shrinking, not growing. Companies like BYD and KTL are moving production to Africa and Latin America to dodge tariffs. US importers, they're stuck signing short-term contracts at 20 to 30% premiums, fearing Trump's next tariff bomb mid-shipment. The American Apparel and Footwear Association says landed costs spiked 18% in Q2 2025 alone. If China were absorbing tariffs, their exports would be flooding in to protect margins. They're not.
So who's paying? You are. And the Bureau of Labor Statistics inflation data is finally catching up. Bessant insists the U.S. won't default. He's technically right. Default's not the only way bondholders lose. Inflation, currency devaluation, and maturity mismatches erode returns without missing a payment. Treasury's latest bond auction proves it.
30-year yields hit 4.98%, while 5-year notes hold steady at 4.23%. That's a yield curve screaming long-term doubt. The Federal Reserve notes foreign demand for long-term debt dropped 14% quarter over, with Japan and China dumping $48.7 billion in holdings. Moody's is eyeing a U.S. credit downgrade, citing unprecedented policy instability. That's market fear, not just numbers. Best dodging a debt ceiling deadline isn't clever. It's fear of sparking a bondholder panic. But investors aren't waiting. They're shifting to shorter maturities, because while the US might not default on paper, that paper's value is quietly eroding. Inflation's eating it, and it's not stopping unless something shifts. So here's the big picture. China's export slowdown, collapsing cargo traffic, rising borrowing costs, and a Treasury Secretary caught between spin and silence. Who's really calling the shots? Bessant is banking on optimism, but Wall Street's already betting short. Beijing's moving markets with quiet moves, not headlines. And US consumers, you're already footing the bill. What happens if the debt ceiling rises, but trust doesn't? Share your thoughts below. Is this just another economic cycle, or the start of a deeper correction? If trust collapses post-debt ceiling, America's not solving the crisis, it's just delaying the reckoning. Thanks for watching. Smash that like button, subscribe, and check out our next video on your screen.